Hello, everybody. I'm Natalie Brunell. Thank you so much for checking out my show, where I get to hear from the leading voices in Bitcoin, financial markets, political structures, philosophy, and more. Please make sure you're subscribed to the show. And if you're watching this on YouTube, like this video so more people see it and hit that notifications button so you don't miss out on any new content. This podcast does not provide financial advice. It is for educational and entertainment purposes only. So make sure you always do your own research before making any financial decisions and be aware of your risk tolerance. I'm able to produce this show thanks to my sponsors, and I'm very picky about who I choose to partner with. So I hope you'll take the time to listen to the ad reads throughout the show. All right, now to my main partner, Swan Bitcoin. I'm proud to partner with Swan because it is a Bitcoin-only company focused on helping people save for their future and self-custody their Bitcoin, not trade it. Swan offers a private client service, retirement planning, tax loss harvesting, and even home equity conversion. Swan is also committed to educating millions of future Bitcoiners through free educational resources and media projects. I actually use Swan to dollar cost average every day. I deposit a little bit every day that's equivalent to what I might spend on a meal, because I actually read that dollar cost averaging daily ends up with a lower cost basis than weekly or bi-monthly at the end of a given year. Swan also produces my show, Hard Money, which reports on Bitcoin adoption and macro trends around the world. So make sure to subscribe to that as well. And to learn more and get $10 in free Bitcoin when you sign up, head to swanbitcoin.com/Natalie Brunell. All right, it's time for the show. Lyn, it's so good to see you. How are you?
Pretty good. How are you?
Good. You are my first official interview in my new home. I have a new headquarters for Coin Stories and Hard Money in the Midwest. So forgive it. It's a work in progress, but I'm so honored that you're going to be my first guest here.
Happy to be. Thank you.
All right, let's start a little bit with Bitcoin, actually, because it's had a little mini rally. I actually left California and it was around the 17,000 mark. I plugged my block clock back in 3 days later and it's 21,000. What do you think is the cause for this rally?
So I think overall, a lot of it has to do with liquidity. So historically, Bitcoin has been one of the purest liquidity plays. So when you look at various measures of domestic or global liquidity, generally when liquidity is rising, that's pretty good for Bitcoin. And when liquidity is falling, Bitcoin's usually either going down or sideways. And starting around the beginning of Q4 of last year, some of the liquidity indicators started to bottom and turn back up, at least temporarily. And I think that, much like other assets had a rally, I think Bitcoin would have had a rally back then, if not for the whole FTX debacle. And so that kind of delayed the rally, but with that somewhat resolved, and now kind of moving forward, I think Bitcoin and other aspects of the ecosystem are kind of having their rally, which is really a liquidity rally. And so, basically liquidity indicators look okay for the next couple of months, but overall long term, they're still not in a very good place.
Well, it's really interesting because before the price started to go back up, you wrote in your last newsletter that the last time the 2-year Treasury yield dropped below the Fed funds rate near the top of interest rate hiking cycle, it marked the end of the cyclical bottom for Bitcoin. So is that perhaps what we're seeing?
Yeah, so I kind of pointed that out as like something that no one should trade on that specific thing, but it's more like an observation. And that part of the underlying causation, that correlation, is that generally that's the 2-year, the market kind of assessing that the Fed's getting close to being done its hiking cycle. And so that's kind of what happened last time, where when the 2-year rolled over the Fed funds, that ended up being the top of the hiking cycle, and that ended up marking the bottom of Bitcoin. And so right now, I think we're seeing shades of that. It doesn't mean that it's the exact bottom. It doesn't mean that the bottom's guaranteed in. But I do think that the part of the downward move in Bitcoin that was specifically from the dollar rally, I think that's kind of behind us. And now I think we probably have a longer grind ahead of us to, kind of start rebuilding from here. But I think when you look in the second half of this year, there's still some liquidity concerns. And so kind of like how in the prior Bitcoin bear market, you had the major bottom in, say, late 2018 into 2019. That was the big bottom. But then you kind of had like a later liquidity shock through March 2020, where you went down and went up much faster. It was again, another liquidity issue. I wouldn't be surprised something like that, like a sharp retest, but it's too early to say, because it partially depends on what humans do, what Jerome Powell does, what different policymakers do. And of course, that's always impossible to predict.
So do you think right now that Bitcoin's more affected by the macro environment as opposed to, let's say, the crypto dominoes that were falling, even though we just had, I believe, right before we started this conversation, headlines that said DCG is preparing, or Genesis is preparing potentially for bankruptcy?
So I think there's still big things like that can move the crypto specific industry. But overall, like historically, Bitcoin has been very correlated to macro factors and specifically liquidity. And I've looked at it over the past couple of years because a lot of people they look at the halving cycle. That's obviously got some degree of correlation. But then if you look at say Bitcoin and the Purchasing Managers Index, which is one of the leading macro indicators, generally when it's rising, it means the economy is expanding, growth is accelerating. When that's going down, growth is decelerating. If it goes below 50, it's potentially outright contracting. And generally, Bitcoin's rather correlated with PMIs. It usually runs a little bit ahead of PMIs. Like it usually front runs it a little bit. And then I looked at it and saw that basically liquidity generally front runs PMIs. And Bitcoin tends to be very correlated with that liquidity. And so for the past 3 cycles or so, it's already been somewhat of a macro asset in that sense. But of course, if you have a big enough industry specific blow up, like we saw with FTX and like you might see with some of these others, that can temporarily override the macro factors because it doesn't matter if liquidity is good if there's some massive forced selling whale out there.
How would you describe liquidity right now in the treasury markets? Let's turn a little bit more to the macro environment, because one thing that I guess I'm just constantly surprised by is the fact that we aren't officially in a recession yet. We had 2 consecutive quarters of negative GDP growth, but then we had positive. And I know that the service sector is still relatively strong. There's low unemployment, but it certainly feels like we're in the middle of this very significant economic slowdown. So how are we not in a recession?
So most of the indicators point that we are like early stage recession or late stage expansion. And so a lot of the leading indicators like, conference board leading indicators, purchasing managers indices, those things are rolling over. Industrial production's rolling over. Inflation adjusted retail sales are rolling over. And the strong area, as you point out, has been the labor market. Historically, that is a lagging or coincident indicator, meaning that by the time unemployment is rising, you're usually already in a recession. And that's part of the reason why those 2 negative quarters weren't kind of a full recession is because unemployment was still pretty low and not really worsening yet. Even in the labor market, though, we're starting to see that some of the early indicators there are not looking good. So, for example, if you look at overtime hours, those are on the downtrend. If you look at temporary help, that generally is a more volatile and leading part of the overall labor force. Because imagine if you're a small business and you're running into tight times, you might reduce your temporary help service before you would let go permanent employees. And so those are actually down year over year. And so basically there are multiple small signs that the labor market's cracking, which combined with all the other indicators, inverted yield curve, contracting PMI, it kind of points towards likely recession. But I think we're still in the kind of either the pre-recession stage or they always declare a recession months after it happens. So it's possible that this is like already part of the recession. But if it is, we I think still really early stages.
And how are valuations looking? Because I know that there was a concern about equities earning multiples last year, but now it's more so corporate earnings for this year, right?
Yeah, so 2022 was a story of earnings multiple contraction. So it's not like earnings went down yet. Basically, you had some non-energy earnings fall a little bit. That was offset by energy earnings. So overall, S&P 500 earnings are currently fine. But you had because you had a sharp rise in interest rates, you had a sharp reduction in valuations. And one simple way to think about it is if usually the 10-year treasury is like the benchmark that you compare equities against, right? If you can get a 6% yield on a 10-year treasury, you might look at equities and say, I'm only going to invest if I can get 5% better than that, right? So I want 11% expected returns. Therefore, I need to buy them pretty cheap if I want to comfortably beat the treasury. On the other hand, if the treasury is yielding 1% and I still want a 5% equity premium, I might buy equities even though I only anticipate that they're going to give me a 6% return. And therefore, I'm willing to pay more like a higher earnings multiple, lower dividend yields, things like that. And so as you've seen a sharp rise from your zero yields all the way up to well over 4% at one point, that put a lot of downward pressure on equity valuations, especially growth-oriented equities. And I think that part of the story is now largely behind us. And the question for 2023 is, are corporate earnings themselves going to be very weak? And I think that, I don't think they're going to collapse, but I do think that they're going to be weak.
Well, and one thing that you also mentioned that I thought was really insightful is the fact that even if they don't necessarily keep hiking rates, let's say they want to hold them in one position, that essentially does get tighter in and of itself because debt comes mature, and then all of a sudden you have to refinance at these higher rates. And we're already seeing so many bankruptcies. We had Bed Bath and Beyond today. I think you tweeted Party City. So is that also going to impact the greater picture?
Over time, yeah. So a lot of people have been surprised at how much the Fed's been able to tighten. Somewhat me as well. Basically, if you would have asked me a year ago, would I think the Fed would get this high, this quickly? I would say no, probably not. But if you do it fast enough, you can get away with it for periods of time. I mean, if the Fed just came out and said, interest rates are 7% for one day tomorrow, it's not like all these companies go bankrupt. It's about both the height of that interest, and then it's also about the time spent at that interest level. And that's because a lot of debt is fixed rate. So homeowners have, 30-year mortgages, corporations have 5, 10, longer bonds. Government also has a range of maturities averaging 5 or 6 years, but it ranges from, almost instant to 30 years. And so when they sharply raise interest rates, that only starts affecting the marginal debt that comes, due and then gets refinanced. So if you just leave that interest rate where it is quarter after quarter, that starts to impact more and more and more types of debt, even though you're no longer raising the interest rate. And of course, another factor to consider is not just the nominal rate, but also positive rates, right? So if you look at some emerging markets like Turkey, I mean, if you have this, I don't have the numbers in front of me. Let's say you had 80% inflation and you had 40% interest rates. Is that tight? Of course not, right? So that's very loose. So a less extreme example is that if you have, 7% inflation and you have 5% interest rates, are you tight or are you loose? And the answer is that you're actually pretty loose. And so real yields are still negative in many ways of looking at it. Now the challenge there is that there's multiple ways to measure real yields because CPI is inherently a lagging indicator. It's backward looking, rates are forward looking, and so it's hard to do that apples to apples comparison. So there's things like break evens, which are basically ways to measure the market's assessment of forward inflation. But then the problem there is that it's usually very inaccurate. And they were not expecting inflation that we got in 2021, 2022. And so right now, overall, we're still not that tight relative to inflation, although I think we're getting tighter as inflation comes down and as we stay at these tighter levels for longer.
Right. And did you see that update that came out that apparently the CPI calculation is going to be different starting in February as opposed to looking at 2 years? It's going to be one. So a lot of people think that all of a sudden it's going to, show us a lower number that's essentially not necessarily manipulated, but you're changing the calculation on us.
So I think I've seen a number of people kind of report on that. I think somewhat incorrectly. There's a nuance there. So basically, inflation is always measured year over year. But the question is, what basket are you measuring inflation by, right? And that's always been a long-term controversy with CPI, which is essentially that you buy a basket of goods and I buy a basket of goods and services, and our baskets are not identical. You might spend more in one category, I might spend more in another category, and so if we calculate our personal inflation rates, they would not be identical. That's like Michael Saylor's quote that inflation's a vector, not a scalar. It's like the mathematical way of putting it. And what the CPI tends to do is say, okay, what is the average American's basket of goods and services? If we do all this research and say, what is the average basket? And of course, the basket changes. If you looked at a basket in the 1970s, it's different than the basket today.
Right.
They didn't have laptops that were like talking on. And so basically they regularly update the basket that they use as representing the what they calculate CPI by. And they used to use a longer rolling period to determine what they're actually how they're going to weight that basket. And what this announcement says is they're only going to look past the last year, which means that the basket changes more rapidly. And that can actually sometimes result in lower measures of inflation, or it can result in higher measures of inflation. So for example, during the COVID shock, the lockdowns, people stopped buying services. They stopped going to restaurants, they stopped flying, they start buying electronics, they start remodeling their home more, they consumer durables. You had this like mismatch, and then everybody comes out of lockdown, they all start flying, they all start going to restaurants, and then they stop buying consumer durables, right? So services are now having inflation. And so That actually it will affect the numbers around the margins, but I don't think it's going to have this big like 1 month effect that I've seen some people report on.
Do you think that they made this change right now to get a lower print? Do you think there's some sort of agenda behind it?
So I lean towards no, because I actually, if they're only looking at the past year, they're actually going to look more at services, and in some ways, those are hotter right now. And so it actually might not even result in a lower metric. I think you'd have to go down the actual. You'd have to compare that basket. I think it's one of those things where in the near term it won't have a significant effect. Around the margins it will. Um, and if you want to ignore the effect overall, I would just keep looking at money supply, right? Because money supply is flat to down over the past year after being explosively up over
Right.
the past 2 years. And so I think any way you measure it, you're going to get, a decelerating inflation, this year until there's again some sort of policy shift. So we had a policy shift all last year, and I think we're going to be kind of in this period for a while until there's another policy shift.
Can you elaborate a little bit on the money supply? I'm assuming you're referring to M2. I know you tweet a lot of charts about that. For those who are watching or listening to this that are still a little bit unfamiliar with M1, M2, can you break it down very simply and talk about the changes that you are seeing since before we did have that explosion up with money printing and stimulus, and now we are actually going in the opposite direction and what that means for everything from equities to commodities?
So there are a lot of different ways to measure how much money is in a given fiat system, because there's this big fractionally reserved system. There's multiple layers to it, and the cleanest way to think of it is base money and broad money. So base money is the kind of the lowest form of money, and that consists of physical dollars in circulation, as well as things like the reserves that banks have at the Fed. So it's core money. Then from there it gets multiplied. It gets fractionally reserved and multiplied into broad money. And so broad money it still includes physical dollars, but then it also includes for the biggest component by far is bank deposits. So for example, you and I might have a bank account. We hold our quote dollars at the bank. It's an asset for us. It's a liability for the bank. They hold their cash at the Fed, which is the asset for them, and it's a liability for the Fed. And broad money is much larger because, of course, banks don't have all your money just sitting, like in a vault in the bank. They're lending it out. They hold a number of assets that exceed their liabilities, but those
Mhm.
assets are not just dollars. They're mortgages, they're bonds, they're all sorts of different things. And so they actually only hold a small percentage of that as cash at the Fed. And so when the Federal Reserve does quantitative easing or quantitative tightening, they directly affect the base money, and to a lesser extent, they can affect the broad money. Whereas broad money is largely affected by whether or not banks are lending money, and how big the fiscal deficits are. Those are the two big levers that affect overall broad money. And so what this shows overall is that in 2020 and 2021, you had a big increase in broad money, which was very different than 2008. So in 2008, you had a big increase in base money, but not broad money, which is why it wasn't nearly as inflationary. You basically just recapitalized the core of the system, not the periphery of the system. Whereas in this period, because there was so much fiscal stimulus, banks checks went right to people's accounts. Their actual spendable money went up substantially,
Mhm.
and so more money chased roughly the same amount of goods, and you got inflation. But because now the Federal Reserve doing quantitative tightening, because fiscal stimulus, there's no more like those like fast acting types of checks flying around, PPP loans that turn into grants, things like that. Now you're getting this like flatlining and even marginal contraction of the amount of bank deposits and other measures of broad money in the system.
Well, and commercial banks are really flush with cash right now, right? They're making a killing. And yet, retail investors, they're not seeing a huge increase in their savings interest rates. Why is that?
Partially because bank deposits are sticky. So a lot of people, if you've got $100,000 in the bank, you don't just like move it around every month depending on where the best rates are, right? It's actually a lot of paperwork and annoyance to open a new bank account, move things around, use all sorts of hidden fees, hassle, time expended. And so basically, when banks are starved for deposits, they're more likely to raise rates. Right now, they have plenty of deposits. Most of them in aggregate are not saying we need more deposits. They have pretty high cash levels relative to their loans. They're not really banks. They're not really starved. And so instead, they're saying, well, we're going to raise rates as slowly as possible and just kind of maximize the spread between what we are lending at and what we are borrowing at. And so, from a consumer perspective, if someone is trying to optimize where to hold their cash, generally things like money markets, like a Fidelity money markets account that's going to pay better. T-bills, a different, kind of a cash equivalent, but that's gonna pay better. Whereas actually holding your money in banks is going to be, less than 1% usually, unless you do longer term certificates of deposit, because the banks don't really need your money, and so it's they're not fighting over deposits at the moment, and so they're holding rates low, and they're actually earning a really good spread because their bank reserves, like what they hold at the Fed, they're getting paid, well over 4% on. But
Right.
of course, they're not passing it down because they're not obligated to, and we're not
Right.
we're not we're not fighting over, bank deposits.
Right. And the Fed doesn't want them to be lending out because that would be inflationary, right?
Yes.
How would you rank the Fed so far on its attempt at a soft landing? And what are the possible scenarios in either direction at this point?
Well, so it's too early to say because we're not necessarily in a recession yet, although we have kind of pre-recession, warning signs, or early recession warning signs. But when you have like a yield curve this inverted, when you have economic activity slowing down, when you have a purchasing managers index sharply rolling over, all that's pointing towards recession. So I think you can only give them a full grade after the fact. I think we do have enough information though to obviously be critical of the Fed. I mean, they were, talking about how they were going to not even thinking about raising rates, that they were going to hold rates low for years, that any inflation would be, not that big of a deal and transitory. Then you had a massive inflationary spike, and then they suddenly shifted course and started changing everything. And you can imagine how if you're, you're actively managing the price of money, if you're actively managing the ledger that everybody uses, sharp changes like that and flip-flopping your outlook and your, what you're calling for can cause quite a lot of disruptions. So I would say that, I think they're obviously their models need updating. I don't think they were dismissive of the sharp growth in broad money supply, saying that that's not going to be a big factor for inflation. Where there are a bunch of us saying, no, it's very likely to be, with a mild lag, a big impact on inflation. And so now they have arrested that, they have helped that roll over and solidified that, but now they're doing so generally through the lens of demand destruction. So it's like you out of the frying pan into the fire, and I think they're going to have another issue to go with after over the next year or two.
It's time for a quick break to hear these messages from my partners. First up, iTrustCapital. iTrustCapital lets you invest in Bitcoin for your retirement with the tax benefits of an IRA. You can defer taxes on gains using a crypto IRA, or with a Roth IRA, you can withdraw tax-free at retirement. And here are some important things to know given the recent crypto contagion. iTrust does not lend against client assets. iTrust accounts are also FDIC insured up to 250,000 US dollars, and iTrust does not hold customer assets or money. Assets are actually held between Coinbase custody and a custody platform called Fireblocks. And Fireblocks, by the way, underlies pretty much the entire industry. Their multi-party computation technology is the gold standard of custody for institutions and allows for private keys to be separated, encrypted, and shared across multiple parties in cold storage. Separately, all US dollars are held within iTrust's bank, Signature Bank in New York. So if you're doing retirement planning and considering adding Bitcoin to your IRA portfolio, you can sign up for an account and get a $100 bonus at itrust.capital/Natalie Brunell. All right, next up, Bitcoin Conference 2023. This is the ultimate Bitcoin event every year, and it's going to be held once again in Miami Beach, May 18th through the 20th. Last year, there were about 30,000 attendees, and it's hard to believe the scale until you see it in person. There are incredible speaking sessions featuring the world's biggest Bitcoin voices, networking events, games, parties, and of course, Soundfest. I actually credit my career transition to the Bitcoin conference because I went for the first time in 2021, and that's where I dropped my first episodes of Coin Stories, not expecting this to become my full-time job at all, but just hoping to meet Bitcoiners and find more guests for the show. I actually went up to people like Michael Saylor backstage with a business card, and that's how I got him to come on the show. So anything can happen there, especially if you dream of working in the industry. Ticket prices go up every month until May, so don't miss out. And for 10% off, use the code HODL at b.tc/conference. I'll see you there. I've heard several analysts out there say that they believe that Powell is trying to effectively end the Fed put. I wanted to get your take on that, on what and whether, it's sort of his mission and a part of his legacy to end what maybe he feels led to a lot of wealth disparity and a weakening of the middle class. Do you think that he's trying to end the Fed put? And do you think that if so, that could be successful?
So I think he is, but I think the Fed put is already a little bit different than people suspect it is. They often think that the Fed jumps in when the stock market goes down, and under Greenspan that was some extent true. That was kind of I think the worst era of the Fed put. Under Powell, from the very beginning of his tenure, he wasn't jumping in just because the stock market was going down. He would jump in because other things broke. In the famous Powell pivot of late 2018, early 2019. That was because credit markets broke. People looked at the 20% drawdown in the S&P 500 and were like, "Oh, that's why Powell changed course." And it's like, no, underneath the surface, there were the bigger part of the iceberg was breaking, and that's what Powell responded to. Same thing in March 2020, Treasury market broke. Also, the repo spike in 2019. These were all deeper plumbing issues, and so I really don't think Powell's doing anything different than he's already been doing, which is he's only willing to respond to deeper things in the system breaking, not equities. For the past, this whole tightening cycle, none of those types of markets have been breaking. Credit markets have not been breaking. Treasury markets not, it's been low liquidity, high volatility, but it's not been broken. No repo issues, and so he's willing to basically tighten until he either causes an outright recession, or gets inflation super low, or one of those kind of aforementioned, deep system things breaks.
Well, you alluded to this earlier, this idea that, a lot of people were surprised that they were able to tighten this much and this quickly. And I know the last time I talked to you and several other people, it's like the question is, when is it going to break? So, I mean, why haven't things broken? And why did we think that the economy couldn't sustain these higher rates?
So again, part of it is that it happens so quickly and it's not had time to fully go through the system. Monetary policy happens with a lag. And so just because interest rates are higher, most debt remains unaffected because most debt is fixed rate and just matures over time. So it's just over quarter after quarter, that'll start playing into interest expense. And another factor is that going back to that Q4 of last year, liquidity change. So as economic indicators slowed down, as the market started to get less hawkish about what they thought the Fed was going to do, that took the edge off the dollar index compared to other currencies, and that's kind of allowed for a rebound. And so, for example, late last year, the treasury market was looking really bad. It was looking increasingly illiquid. Auctions were, treasury auctions were doing really poor, and generally you get a very strong inverse correlation where if the dollar is strong, the foreign sector is selling treasuries or not buying treasuries. And so all of that was kind of a negative loop, causing more and more distress and liquidity problems in the treasury market. But by weakening the dollar, as the market started to say, okay, Powell's not going to be able to raise rates too much more, they started taking the edge off the dollar, and that actually improves the treasury market. Now foreigners can come in and buy some treasuries again, at least stop selling treasuries. And so you have basically this temporary improvement in liquidity that has allowed things to keep going. And kind of the two main components of domestic liquidity. One of them is the Fed's balance sheet, which they're still drawing down. That's the part that hasn't taken a reprieve. It just keeps going down. But the other big one is the Treasury general account. So the Treasury Department holds their cash balance at the Fed, and the Treasury has control over that. They can bring money in, they can put money out based on how much bonds they're issuing, how much they're spending in a given period of time. And ironically, because of the debt ceiling issue, one of the things they're doing to delay the issues caused by the debt ceiling is they can draw down their cash balance and basically spend more into the economy than they're issuing from bonds. And so when they draw that down, that's actually positive for liquidity. And so partly the past quarter, you've had the Fed still draining liquidity with their quantitative tightening, but then you've had the Treasury general account adding to liquidity. And that could happen for a few more months until the Treasury general account runs out. And then that's where I think you get a resumption of probably negative liquidity conditions, assuming the Fed is still able to do quantitative tightening at that point.
Are you referring to toward the end of last year, this sort of chicken pivot? I think I've heard it referred to as with the Treasury injecting more liquidity, deficits going up while tax receipts are coming down. Was that like a bit of a mini pivot just to keep things going and working in the system?
So partially, yeah. Basically, if you look at the Treasury's own forecasts, they actually every quarter they give an assessment of what they think they're going to borrow and spend over the next 2 quarters, and then they update that every quarter, and they give like a quarter end target for what they think their Treasury general account is going to be, and they expect it to be much higher. They expect it to go up to 700 billion, and then to kind of settle around 500 billion. But instead, they've been staying under 400 billion,
Right.
and they've not hit their own targets, and so they've essentially left more liquidity in the market than they said they would.
Right.
And I think it's hard to say for sure what reason that is, but I think a lot of it has to do with the debt ceiling. And when the U.S. government runs into a debt ceiling issue, it's not that like this week, like roughly today, they're running into the debt ceiling. That doesn't mean that they quote unquote default today. They start turning to what they call extraordinary measures, where they can do partial government shutdowns to spend less, per month. They draw down from the federal employees, like it's called the G fund, is where they hold some like treasuries. They pay it back after it gets refinanced, but they kind of draw from that. And then the other thing they do is they draw down that treasury general account. It's like, imagine if your income got shut off tomorrow, but you had a bank account. You just like, well, I'm going to keep paying the bills for the rest of the month until I'm fully out of money. That's essentially what they do once you hit the debt ceiling, but before you actually run into that crazy default period. And ironically, that's good for market liquidity because they're taking their
Yeah.
existing bank balance, and they're just kind of slowly putting that into the economy without drawing money from the economy for treasuries.
I mean, every time talk about the debt ceiling comes up and once again we raise it. At this point, I mean, a moving ceiling isn't a ceiling, right? So I just it always frustrates me because it's like they talk about wanting to be more responsible, they blame it on the people that came before, and then they just vote to raise it again. So we are no better off, right?
Yeah, a lot of it is political theater. The way that was established in I think 1917 and about 100 years ago. And the reason they did that is because before then they had to like authorize every specific like bond issuance. So that the Congress would say this is what we're going to spend, and you're going to do like 5-year treasuries. So you basically micromanage the treasury. And of course that became, especially during World War I, that became too big and too unwieldy for Congress to do. So the Congress said, okay, we're not going to micromanage the treasury issuance. Instead, we're going to say, okay, the Treasury Department could figure out, they're the accountants. They can figure out exactly what durations and what instruments they want to use, and we'll maintain a ceiling and say, okay, issue whatever you want as long as you don't exceed the ceiling. It's kind of like the Congress is acting like the board of directors, and they're letting the Treasury Department act like the CFO, which makes sense. But then, you basically obviously you ratchet that up every
Yeah.
quarter, every year. And for decades, that wasn't really used as like a political tool. But in this current age of heightened political polarization, it's a chance for the outer power party, at least the party that doesn't have the presidency, to use that to basically get concessions or draw attention or try to build momentum for their next election. But then, of course, when they're in power, it's like, oh, it doesn't matter. We don't have to worry about the debt ceiling. And then you're out of power again, and you're freaking out about the debt ceiling. So a
Right.
lot of it is theater and just kind of politicians using the tools that they have available to them.
And politicians always operate in nominal numbers anyway. So,
Yeah.
what is your take on credit markets right now? You mentioned, more liquidity, it's helping Bitcoin, but overall, what are some risk factors that this might just be sort of a mini bull run in this structurally inflationary environment and this ultimate bear market?
So overall, the credit market is decent right now. It's not one of the most broken parts of the market, so you don't really see super high spreads. They've been on a widening spread overall, and so I think that if we do continue to see all sorts of economic indicators decelerate, we'll probably see spreads get worse. But it's not really one of like the obvious pain points right now. Obviously, around the margins, you have bankruptcies, you have spreads
Yeah.
widening where they should. I mean that's healthy market activity. Um, There's multiple factors there. And so I think overall, as you see a deceleration, um, if it's not a sharp liquidity event, I think assets like gold and Bitcoin, for example, can hold up
Mhm.
pretty well in that type of kind of early recessionary environment. It's really when you get that sharp liquidity problem where credit markets freeze, something like that. And that's happened a lot recently, but that's normally not how recessions played out, right?
Mhm.
We often think of recessions as these big vertical down crashes, but that's really the past handful of instances. Going back prior to then, usually recessions were these more rolling, slow moving problems. And so we'll see how this one plays out. I think some of the major liquidity issues already happened. Again, partly going forward will depend on human decisions. But I think this one could be a more rolling and grinding type of recession. But we'll see.
I was listening to a macro panel earlier this week, and I heard a lot of talk really about deflation at this point. The print is coming down, and a couple of the analysts were saying that we could even see a negative year over year inflation print this year. Do you think that's possible?
So I think it's possible. I probably wouldn't put my base case on negative. I mean, it's certainly going to be lower, and it's already down on a year-over-year basis. I think that will continue for a period of time. You have had a year-over-year slight reduction in broad money supply. So it's not out of the question, especially if that continues for another few quarters, to have a negative year-over-year print in CPI. And that doesn't mean you undid prior inflation. So, for example, if let's say the price of oil doubles and then stays where it is for 18 months, even goes down slightly, you could have negative inflation in oil, but you're still higher than the price you started at, for example. And that's generally what you see in inflationary periods, where you see periods of give back and then a higher high going forward. And so I do think that we're in a disinflationary cycle this year,
Mm.
meaning that we're going to see slower inflation. We're going to see inflation coming off its highs. It's already happening. But that when you look out to the next growth cycle, let's say 2024, 2025, something like that, I think inflation is likely to return. But exactly what level we hit between now and then, do we get down to 3%? Do we get down to 2%? Do we get to negative 1%? Partially that is a policy decision that's hard to predict in advance. Is also partially based on base effects. So how quickly do things decelerate, and then what is the exact month you get to kind of like the low point? And if that happens to be like the exactly a year after like the high point in inflation, that's where you could get, for example, something like a negative print.
Mm.
But I think it would be temporary. I think you'd re-enter an inflationary cycle whenever we have the next, rising PMI economic acceleration period, because a lot of the underlying supply issues, especially around energy, remain unresolved. And so they're
Mhm.
kind of there whenever there's no longer a demand destruction event happening.
Well, speaking about energy and maybe zooming out a little bit more just from US to global, I was curious if you had any takes on Zoltan Pozsar's last essay. I thought it was really, really fascinating. He talked about globalization and the shifts in currencies. He mentioned that we should actually be watching what state leaders are doing as opposed to central bankers, because the central bankers are going to be reactionary. And he talked about something called commodity encumbrance, which is inflationary for the West. Can you talk? I'm assuming you read the essay. Can you talk a little bit about your takes on all of those things?
So I think it's generally accurate. And there's another analyst, Luke Roman, that's been writing about that kind of issue for several years. And so a lot of the ideas that Zoltan's expressing are not necessarily the first person to express them, but one, he's describing them pretty well, and two, he's describing them to a largely institutional audience. And so when Zoltan says it's often more impactful than if another analyst says it, even if they said it a few years earlier. And even in 2020, I wrote an article about the petrodollar system,
Mm-hmm.
and one of the things I highlighted was that China. So the way it historically worked, the petrodollar system is that the United States runs these big trade deficits.
Mm-hmm.
We send out dollars, we get goods and services, and then those countries take their dollars and then they buy treasuries with. They recycle them into treasuries, so they finance our deficit spending. And starting in 2013 with the Belt and Road Initiative, what China started to do is they said, okay, we're going to keep running those surpluses with the United States, but then instead of buying treasuries, we're going to start making loans to African nations, to Southeast Asian nations, to Latin American nations. and we're going to start, basically getting all sorts of commodity rights and infrastructure rights and partnerships to build refineries and things like that. And so they kind of actually, it's sort of like a neo-colonialist financing thing, similar to what Europe does, similar to what the United States does. China started to play that game, but instead of doing it with their own currency, they were doing it with the dollar. It's almost like using the existing system against us. And so that's something I've been covering for quite a while, something that Luke Growen's been covering. And now it's getting a lot of action on the main stage with Zoltan covering. And of course, it's been accelerated by, the invasion of Ukraine and then the associated seizures of funds. And then the whole kind of basically it pulled forward a lot of what I think was already happening. We're already in a path towards shifting from a unipolar financial system to a somewhat more multipolar system. And kind of like how remote work to some extent was always going to happen, but then lockdowns and COVID accelerate it. You take what could have happened in 5 years and put it into 1 year. I think what could have happened in 10 years gets compressed into 3 years, because of some of these recent events. And so I do think the world is more becoming multipolar in that sense. And I do think that a lot of commodities are encumbered in large part because some of these countries are taking their surpluses instead of buying treasuries. They're buying what they perceive as far more valuable, which is the underlying commodities, the underlying infrastructure, transportation infrastructure to get those commodities to them, that sort of thing. And so I do think that's going to be an inflationary pressure as we go deeper into this decade.
And is that essentially what commodity encumbrance refers to, sort of the rights, the ability to take the possession essentially of commodity production? Is that what it refers to?
Yeah, let's say, for example, China goes to Ecuador and says, hey, I see you're having a problem with your currency. You're having trouble raising debt. We can go ahead and we'll loan you that, and we'll give you a decent interest rate. But we're going to get 80% of your future oil production for the next 10 years. Or we're going to partner with you. We're going to build some refineries. But then the thing is that we get right of first refusal on 80% of your output, right? And so you can look at when you kind of look at the whole world, how much oil does the world produce? How much do we use? And what is the marginal difference? It becomes more complicated because then you have to say, okay, well, how much of that is already fully accounted for? If Ecuador doubles its oil supply, and I'm just using them as an example, but if they double their oil supply, that's not necessarily oil that's available to the West. That could be already contractually obligated to go to China first, or at least give them right of first refusal. And so an increasing percentage of marginal commodity production out there is part of some of these longer term arrangements, because that's where a lot of the finance has been going. It's kind of it's tied into that Belt and Road Initiative type of global lending model. And so it's basically saying, okay, we'll lend you money. Sometimes it's just as simple as you pay us back interest, but other times it's okay, if you have trouble paying interest, we'll either get the asset or we'll get rights of future production from that asset. And so basically those commodities become increasingly encumbered, which means somebody already has they're already owed to somebody.
Right. And China's getting oil and liquid natural gas at a steep discount. And now they're paying in different currencies. Now they're not paying in the dollar, they're paying in the yuan, but now also that is backed by gold, is it not? So we're really seeing global currency shifts that ultimately threaten US global dollar dominance, right?
Yeah, so China for a while has been wanting to buy energy and commodities in its own currency. Certainly the seizure and sanction of Russian funds gives China more leverage there, because they can go over and say, hey, I see you have a problem there. We still want to buy your stuff, but we're going to do it in yuan, and you really you're not really much in a negotiating position. Same thing with India, actually. India says, okay, we're going to keep buying all this stuff, and we can look into buying with some of our own currencies now, and making kind of deals like that. And so this, again, is like an acceleration of trends that were already underway. In some sense, the way that I go back and phrase it is that after World War II, the United States was over 40% of global GDP. We were like, most other countries were devastated. We were mostly untouched. And so we could set the rules and build this more unipolar system. Then during the Cold War, Soviets tried to somewhat counter it. They didn't have the population, they didn't have the scale, they didn't have the governance model to fully compete with it. So that collapsed, kind of resumed that unipolar system in the 90s, the 2000s. But with the rise of China, the rise of India, the rise of the euro, you've had this more multipolar system, which is actually a more natural system. I mean, the United States is less than 5% of the global population. We're now down to something like 20% of global GDP, depending on how you measure it. And so we're just not big enough to be like the only, currency that all energy is priced in, for example. It's just not tenable. And then ironically, it's not even good for us anymore because it's really hard to make things here if we
Right.
have a currency that's artificially strong. So it's good to have a strong currency, but it's not good to have an artificially strong currency due to like weird policies. And so basically, and actually that's where I would agree with Luke Groman that he's made the assertion that the whole petrodollar system made sense for like the first 20 years of its existence, like
Right.
during the Cold War. But then once the Soviet Union fell in the 90s, some of these systems should have been shifted earlier and they weren't. And so now some of the same things that used to give the United States a lot of strength, a lot of this dollar hegemony, actually kind of comes back to bite us
Hmm.
ever since that time. And so I do think that dollar hegemony is under attack, really.
Hmm.
But I think it's natural for that to happen. And I think in the long run, the United States, even the current system is bad for the United States, ironically. But of course, it depends on who you ask. It's good for the
Right.
military industrial complex, but
Right.
it's bad for people that actually want to make things in the United States.
Right. Bad for the middle class, but it's been good for the people who carry assets. All right, it's time for another short break to hear these messages from my partners. First up, Fold. Fold is the best Bitcoin rewards debit card and shopping app in the world. You can earn Bitcoin on everything you purchase, from Amazon to groceries to sprucing up your wardrobe with Fold's Bitcoin cashback debit card. And you can win free Satoshis every day or even play for the chance to win a whole Bitcoin by spinning the daily wheel and the purchase rewards wheel. I have an alarm set every day so I don't miss out on spinning the wheel and earning free sats. And it's also a great app to get someone that is totally new to Bitcoin. So if you want to join the fun, head to foldapp.com/Natalie and get 10,000 in free sats when you sign up. And finally, I'm excited to partner with CrowdHealth, a Bitcoin alternative to health insurance. Health insurance costs can be sky high today, and you essentially send money every month to a massive corporation, the health insurance black hole, as I call it. And if you don't need any health care, you never see that money again, right? But if you do need to go to a doctor, you end up having to pay even more out of pocket, especially if you end up as one of the 20% of claims on average that aren't covered. With CrowdHealth, you pay a small monthly fee that goes into an account that you actually accrue over time and is yours to use or keep if you ever leave. You can even save that money in Bitcoin. CrowdHealth is all about community, and the community crowdfunds everyone's healthcare. So if something does happen or you have a doctor visit, CrowdHealth will negotiate down the medical bill much lower than what insurance would be, and then the community helps you cover it. And in return, you help others cover their needs. For more information, you can head to joincrowdhealth.com/Natalie. And if you use promo code Natalie, you get 6 months for $99. All right, back to the show. It seems like there's a search for a neutral reserve asset. There was talk of kind of a BRICS coin. I've also read about this mCBDC bridge project. So there will be a CBDC, and then ultimately, again, the Yuan is backed by gold. So potentially, a country could be incentivized to say transact in it because they could ultimately redeem it for gold if they really wanted to. What can you tell people about the mCBDC bridge project?
So that's a local attempt by a number of countries, including China, to try to build alternative payment systems and settlement systems to the dollar system. And again, this can trace all the way back to the 1940s, which is when they were building the Bretton Woods system. The alternative version was the bank coin, which was that
Right.
instead of the dollar being at the center of the system, there'd be this neutral reserve asset that is like a basket of all the major currencies, and that would be this like settlement unit between countries. That would be like the global unit of account.
Mm-hmm.
That idea did not win out, but it existed to some extent in the form of special drawing rights, the SDRs. So it's like the IMF's money. And so it's always been like this kind of secondary, smaller system on the side. And there have been calls for the past several years to try to resurrect that idea, to build some sort of like digital, SDR, essentially have like this like global neutral reserve asset. The problem is it takes so much coordination. And we have to have
Yeah.
United States, China, Europe,
Mhm.
India, all agree on what the weight stats are going to be,
Right.
what are the rules going to be, who's going to govern it, and things like that. And so instead you've had kind of interest in some of these smaller groups say, okay, we don't necessarily need like a global SDR. We can have BRICS SDR. We can have Shanghai Cooperation Organization SDR. We can have basically a regional block of settlement. And then that can maybe grow the network effect from there. Maybe it doesn't have to include everyone from the start, maybe more entities can join it over time if we get it off the ground, right? And so that's kind of been the shift of focus. And basically this is like a current attempt of it. So we hear about BRICS coin, we hear about these digital bridges and attempts, they're basically what they all amount to is ways to decentralize and kind of increase the number of currencies that can be used to buy energy with, especially the yuan, but also extending out to potentially others. And the way that China is structured is not necessarily that the yuan is directly backed by gold, like it's not pegged to gold,
Right.
but because you can take it and you can go to Shanghai and
Redeem
get
it,
gold,
right.
yeah, you can redeem it. It basically gives oil producers or other commodity producers a decent incentive
Right.
to use it, especially because China is now the biggest trade partner for the majority of countries in the world.
Right. It's almost like before treasuries were risk-free, but now China's trying to make those currency revisions essentially risk-free because you can redeem them in gold. Why not? Could Bitcoin be the reserve asset? Do you think any of these countries are looking at potentially Bitcoin?
I think most are. I mean, Russia already talked about it, how certain payments could be made in it. I think they view it generally as too small. Right now, when Bitcoin's less than like $500 billion, and is this like volatile, free floating one. And so the way that I noticed that the way that academics or economists often approach this is it's like not exactly as they vision. They're like, oh, that can't possibly work. And so I think it will probably keep being dismissed for a while until it's too big to ignore. Right. So right now, all the major powers are looking for these more like, specific agreements, whereas Bitcoin is more like the people's money, right? It's kind of the people's like global settlement asset. And I think that's going to be the case for a while. And, if Bitcoin gets to a point where it's a multi-trillion-dollar asset, and the volatility starts to reduce because it's more widely held, that's when I think that more and more nations will be like, wait a second, maybe we can use this as a reserve asset. Maybe we can use this as a payment system. I think it's just still too small and volatile for it to be on most of the radar in a truly serious way.
I wanted to ask you, Lyn, what are some really big threats to Bitcoin? Right now, the leaders are in Davos, talking about how they're going to centrally plan everything. And they've negatively spoken about Bitcoin already and how they need to regulate the space. What are the biggest threats to this asset class? Because it is still so young and so volatile, as you mentioned.
So there are a lot of ways to slow it down. I think that the lowest hanging fruit would be to cut it off from the banking system. And so, the way that, say, in the United States, we have the First Amendment, and we have other kind of protections that have been successfully used to, defend the use of encryption, defend the use of code as speech, right? So it's pretty hard to tell people that you cannot run a full node open source software, that you can't, memorize 12 words, that you can't, flip a coin 256 times and generate a private key, right? It's very hard to enforce on that level. But it's really easy to tell banks that you can't send money to crypto exchanges or brokerages, or fiat on ramps into Bitcoin and crypto and things like that. And so that's kind of the big lever that could be pulled by the United States, by Europe, and by some of these other major countries. And it depends in part how short-sighted politicians are, right? Because on one hand, they might want, to pull that, be like, no, we're going to defend ourselves against this like rising, like, decentralized currency. We're gonna shut off the on-ramps to it. But then you also drive out businesses from your jurisdiction, right? So if the United States does it, but Australia comes out or another country comes out and says, build all your businesses here, then it basically, in the long run, is probably not going to be good for that. We saw, I mean, back in 2018 and for years since then, India was exploring that, right? They were like, kind of flip-flopping between maybe we should ban all this.
Mm-hmm.
And then it's like they kind of realized like you don't actually ban it, you just ban yourself from it, which can maybe work temporarily, but it's not really a good long-term strategy. And so overall, I think that the biggest impediments are just restrictions on privacy, attempts to make it harder to self-custody your asset, as well as kind of the potential giant attack would be to severing it from the banking system. But that'd be a pretty major event.
Before we start to wrap up, I just wanted to ask you, going back sort of to Fed policy, if you were at one of these press conferences with Jay Powell, what would you ask him?
I think it's a really good question because I mean, I probably try to troll a little bit, not because I dislike him. It's just because I find the process so interesting. I mean, I just my view is that I just fundamentally disagree that actually managing the root layer of money is a good thing, right? I mean, kind of like how most if you talk to most people, you say, would you say that price controls are a good thing? They'd say no, and it's like, well, why are we controlling the price of money then? Like, why are we actively deciding that Florida, everybody in Florida has had the same price of money as everybody in Washington State, right? Why in a country of 330 million people, why do we have this like nationwide price setting thing for money? Why can't we let it happen more organically? Um, but in any sort of tactical sense, I know that those types of questions don't really matter. And the Fed's going to do what it's going to do. It's going to manage its own ledger the way that it sees fit. And so if I was like realistically, if I was at like a Fed event, I'd probably be approaching it like any other reporter does. Like, what factors are you considering for how you're going to approach this? Things like that. So it's kind of like what I actually think versus if it was my job to do that sort of thing, what I would have to focus on in order to, basically get useful information for people in any sort of like near-term sense.
Yeah, but I mean, is there a question where if a reporter asked it, you'd be like, oh my God, that was amazing. And what's he going to say? This has to strike at, something that he's truly intending with this whole market.
I think if you point out like the US fiscal situation, you say, okay, if you hold rates this high for this long, and that starts compounding into higher and higher interest expense on the US debt,
Mm-hmm.
and you start to kind of just place that math in front of them, the math is so painfully obvious, and they always kind of like ignore it. If you could structure a question so they has to kind of address it, it could be pretty funny. That'd be kind of like one of those epic, questions that probably gets around like a clip going around Twitter or YouTube and things
Mm-hmm.
like that. But I think it's going to be ignored until it's not. I think that during the repo spike of 2019, I think some reporters missed up some really good questions because essentially that was a T-bill oversupply problem. And the Fed was in this awkward position of having to increase their balance sheet while saying we're not doing QE. I do think there will be future events like that where they're forced to buy treasuries, even if we're not necessarily in a recession, and the mental gymnastics or the verbal gymnastics they have to go through to explain why exactly they're doing that, that gives reporters a really good chance to be like, so, why exactly are you doing this? You're saying there's too many treasuries in the system. What does that mean?
Right.
And so I think those are the more fun questions to explore.
Right. Well, you touch on that important point we always mention in the Bitcoin space. It's just math, and they have to print. We have to go further into debt. So it kind of makes you question what is all of this for? And where I want to leave this conversation is. You had a conversation once with Peter that I've sometimes thought about, and I have been meaning to ask you about this for clarification for a while, because one of the things that, makes me passionate about Bitcoin is this idea that we could create a system that is more accessible and more fair, where it would be based on sort of the value you provide and bring to the table, as opposed to it sort of rigged where it's the Cantillon effect. The people closest to the monetary spigot get access to the capital first. They get richer and richer. But one thing you said in a podcast, I think it was sometime last year with Peter, is that actually, if you look at QE, as QE increases in our country versus others, it's not necessarily correlated with wealth concentration. And I was wondering if you could kind of break that down a little bit more, because I always thought that because of our system of money printing and QE and injecting liquidity that goes to certain, classes and corporates and all of that first, and they buy back shares, they get richer and richer and they hold the assets, and it's at everyone else's expense, coupled with the fact that with the trade deficits that we're running, we're crushing the middle class, we're incentivizing for all the labor to go elsewhere. So why is it that we've had more wealth concentration here with QE going up, but at the same time it's not necessarily correlated?
So the short answer is a lot of it has to do with fiscal decisions. But if we back up a second, if we kind of examine the hypothesis that QE is heavily correlated with wealth concentration, then one thing that we should find is that if you look at the major countries, the more QE they did, the
Right.
more wealth concentration we'd expect them to have if this was a strong correlation. In reality, we find either no correlation or actually slight inverse correlation. So, for example, Japan did way more QE relative to its economy than the United States did, and yet they have less wealth concentration than we do. Europe has done somewhere in the middle between Japan and us, and they're also somewhere in the middle in terms of wealth concentration. So when you kind of look at that variable alone, you say, okay, clearly there has to be other variables here explaining how wealth concentration erupts that are either overriding this or impacting this in some way. So the argument is not that QE reduces wealth concentration, but that it clearly can't be the main variable if you see such a complete divergence between countries with high wealth concentration and countries that have done a lot of QE. And so instead, what I argue is that fiscal decisions are a large part of how wealth concentration develops, because at the end of the day, mostly what QE is financing the government. So if the government is making decisions that actually are neutral to even reducing in some ways wealth concentration, then QE is not necessarily going to be a big impact on wealth concentration. On the other hand, if the federal government is doing something that greatly exacerbates wealth concentration, then the fact that QE is helping to fund that is going to boost wealth concentration. And so, for example, I point to things like in the United States, we have a much more problematic nutritional situation. And so, and also the way our healthcare system is structured, we pay way more per capita for healthcare, despite having a lower life expectancy than Japan, than most European countries. That's kind of how it's structured. The way that our just tax system is structured somewhat differently. And so overall, a lot of those wealth concentration are a large part fiscal. Actually, a really good example was during 2020, a lot of people focused on the stimulus checks as a cause of inflation. But in my view, the thing that did not get enough attention was the PPP loans that turn into grants. Because a middle class person, and those are subject to a certain income limit, you could get a $1,200 check, $1,400 check. You could get child care tax credit, so another few $1,000s. But if you were running like a law firm and you made like $1 million a year, you could then apply to the PPP loan program and say, hey, I'm gonna have to lay off my employees. Can I have $500,000? And then they say yes, and then you don't lay off the employees. You didn't really need to anyway. That loan's forgiven, and so that $500,000 just went to the already rich partners of the law firm. I mean, we looked at actually it was a pretty public program, and when you look through the list of people that received it, on one hand you do have, for example, some small restaurants received it, right? Some entities that were shut down through no fault of their own would have otherwise gone bankrupt and got to get this program. On the other hand, it was a heavily abused program where investment advisors, law firms, investment research organizations, they would apply to this even though they had no real intent or reason to lay people off, weren't really needing this at all, and they actually got like an order of magnitude bigger capital injection than someone making $100,000 and getting a $1,400 check. And so it's like a series of fiscal decisions like that. Another one was going back to 2008. The fact that some of the banking system was bailed out, which was not purely a Fed thing. So the Fed, all the Fed could do on their own is, print money and buy treasuries and mortgage-backed securities. But in actually the troubled asset relief program was a fiscal decision that had to be something passed by Congress. And so you bail out banks, you don't bail out the homeowners. And so mostly every time there's like a quote unquote crisis, we're funneling money back up towards the top. And a lot of that is in large part a fiscal decision.
That's really interesting. So between like 2010 to 2020, before the pandemic, what was the greatest source, I guess, of the fiscal contribution to wealth concentration increasing during that time, and us seeing, house prices going up and asset prices going up, and the S&P, 7% increase every single year, as opposed to the average person, they're essentially making less every single year due to inflation?
So number one was going back to the 2008 thing, basically bailing out the banks, not the homeowners. That's number one. Number two is by running persistent trade deficits in the United States due to our global reserve currency, due to a number of policies that we do, we basically outsource a lot of labor. And then those trade deficits, a lot of those, even though they're not getting funneled back into treasuries anymore, they are getting funneled back into our stock market. So if, Saudi Arabia is taking their oil money and then they're coming back in and buying assets with it. Firms in China are coming in and buying our single family homes and driving up the prices. So
they have equity now in the banks, not just treasuries.
Exactly. So they're a lot of that was funneling our deficits back into our asset markets, which if you look at the way the stock market's distributed, 10% of people own like 89% of the stock market. So that's going towards the top 10%. Then we had tax cuts that mostly favored the wealthy. So basically, if you were making the middle class, you got a smaller tax cut. If you were doing pretty well, you got a bigger tax cut. And then in 2020, again, basically, if you were making middle class, you got like a little bit of a bailout. If you were running a small business that didn't need the money at all, and you had to play your cards right, you could get $500,000, you could get $1 million. And it's like getting, dozens and dozens and dozens of individual stimulus checks.
Right.
And so basically, every time you kind of encounter this decision point, instead of funneling money towards the bottom or not funneling money at all, we always tend to funnel money kind of upward, and we disguise
Right.
that with like small handouts to the middle,
Right.
and everybody kind of talks about those. Well, kind of like the other one was the bigger money was kind of funneled up.
That's so interesting because, when I was a reporter, I would cover a lot in Southern California, the homeless crisis. And, it's not like they were going out handing money to poor people. I mean, they did have like one of those debit cards that they could cash in and weekly purchase their necessities. But actually, they were funneling a ton of money to developers and to the construction companies that were going to build supposedly affordable housing. And yet the housing per unit was costing cities and counties like ridiculous amounts of money. And I'm like, oh, that's also essentially fiscal, but on a local level, right?
Yep, exactly. And a lot of that. So basically, the more corrupt or incompetent that is done, sometimes corruption and incompetence are the same thing. Sometimes they're different.
Right.
But either way, if that's done in a very, corrupt or incompetent way, a lot of it flows to the top
Yep.
instead of flowing to the people that you're intending to help. Or some of these programs, like especially the federal level, from the beginning, are designed so that they pass because they have optics that the middle might like.
Right.
Whereas that's like the carrot to keep them distracted while you're actually funneling the bigger money towards the top. And that's been something we've had multiple cycles of that so far, really, especially starting with 2008. But it goes back even further. I mean, you can go back to the 90s with long-term capital management.
Mhm.
Basically, depending on what point you want to start this at, but that's essentially how we've run our system for the past couple decades.
You're so right. Lyn, thank you so much for clarifying because now that really crystallized what you meant for me. So thank you. Anything else you want to share in this crazy start to the new year? Bitcoin kind of rallying. But we still have a lot of, I think, pain, choppiness, volatility ahead as we continue to tighten. Debt matures and we're not sure what's going to happen in the next year, but eventually they will have to print like we mentioned earlier.
Yeah, I think 2023 is a transition year, just like 2022 was. So basically, 2020, 2021, you had this huge injection of liquidity. 2022, 2023, they're trying to pull some of that out. And I think you have to really kind of probably look into 2024, 2025 until you might see another round of liquidity. Now, these things are subject to change because it's based on actions we can't anticipate yet, human decisions. But generally, I think it's like this is a year where you want to build a good base, whatever it is that you do. You want to build a good base, whether it's a financial base, whether it's something you're working on, build that base and just kind of survive. Basically, don't necessarily expect things to boom this year. And it's going forward into the next cycle is when you want to have whatever you're building ready to go.
Thank you so much for sharing your insights. And I hope everybody subscribes to your premium newsletter. I like what Peter said. It's scandalously cheap. Everyone should sign up. Thank you so much, Lyn. It's just always such a pleasure. I learned so much from you. So thank you so much and Happy New Year.
You too. Thanks for having me.
Thank you so much for checking out this show. Again, make sure you're subscribed so you don't miss out on any new content. And I love to hear your feedback. Leave a comment or send me an email at natalie@talkingbitcoin.com. Let me know what you think if you have guest suggestions, and I'll see you next time.